Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500, and today is DTE Energy Company, ticker DTE. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, we have a market cap of $21 billion, enterprise value of $38 billion. This is a multi-utility company. Let's look at the business description. Engaged in utility operations, has an electric segment, generates, purchases, distributes, and sells electricity, 2.3 million customers in Michigan. It has fossil fuel, hydroelectric, and nuclear plants, as well as wind and renewables. Has some substations, transformers. They also have a gas segment for natural gas. Looks like this is also in Michigan. They have distribution miles for pipelines. And they have a power industrial metal segments for metallurgical coke, pulverized coal, petroleum coke, steel, paper pulp industries, and an energy trading segment. So basically, this is a Michigan-based utility company, and it's multi-utility because it's both electric and gas. So we have a beta of 0.63. Generally, a lower beta tends to mean a higher quality company. Why is that? That's because the low volatility in the stock generally means there's low volatility in the results of the company. Not always, but it tends to be a good suggestion of that. Now, return on invested capital chart. This is backed up here with this beta of low volatility. When you look here, basically, there's very little volatility here in these numbers. It's not super stable, but it's pretty stable. First up that you can instantly notice is there's not a single year of losses. So you have 20 straight years of profits, which is a very good sign. Now, that's not uncommon for a utility company, but still, if you know that every single year you're going to make a profit, that really reduces your downside risks. When you're looking for asymmetric upside versus asymmetric downside, you really want very low chances of losses, very low chances of bankruptcy, and high opportunities for high performance. Now, so what this is showing instantly here, just in a quick glance, is that we have very low chances of losses, very low chances of major downside scenarios. That's good. Now, it doesn't tell us upside scenarios. It does tell us no downside scenarios. Now, what I don't like as much about it is that you're basically trapped between this 2.5% and 5% line. You spend most of the last 2 decades between a 2.5% and 5% return on invested capital. You have 1, 2, 3 years jumping above 5%. That's in 2007, 2014, and 2017. But again, 5% is not a very high number for return on invested capital. Your return on your capital is going to limit your returns as a shareholder. Now, shareholder returns is driven mostly by return on equity, but leverage can only get you so far. You'd really like this number to be in the 10% range, but you see there's not a single year where they're above 7%. And so that tends to be more on the negative side in terms of business quality, that they're just not getting high enough returns on capital to get you double-digit returns over long periods of time. Single-digit returns, certainly. You're avoiding losses, but this is more bond-like returns based on what I'm seeing here. Now, they do return the 4% return on invested capital into a 9.9%, let's call it 10% return on equity. That's my minimum. I really want to see 10% return on equity. My target number is 15% plus, but you don't even hit the 10% number. You're right at that piece here. And again, there's a lot of leverage on this business. We saw at the top you had $17 billion in net debt on a $21 billion market cap business. So you have a substantial amount of debt on this business, and yet it only barely hits a 10% return on equity during a very low interest rate time period. That's concerning. As interest rates rise, your returns as a shareholder are going to get worse and worse because you're going to have to pay interest on that debt, and the debt is instrumental in allowing you to operate anywhere close to a return on equity that gives you reasonable returns. When you combine that with a PE of 19, this is actually pretty highly priced. I mean, you think about this price to book of 2.4, right? So if book value is returning 10% and price to book is 2.4, then shareholders are getting like a 4% return. That matches with your return on invested capital. That matches with this PE ratio, which is about a 5% equity yield. Now, if you grew your revenue at 5%, you have a 5% equity yield, then again, that's targeting close to a 10% return, close to a 10% return here. But I think that's probably your max. I think your max return is something like 10% here. And maybe your minimum is something like 3 to 4%. So if you like the fact that you're not going to lose money, then that gets interesting. But to me, this is on the overvalued end. I'd want to get a lot cheaper because your EPS is only growing 1% a year. Now, we need to figure out why that is, because with the revenue growth of 5%, you should be able to grow EPS at least 5% a year. I don't know why they're not being able to do that. Well, and it looks like they kind of are. I mean, you grew your revenue from $8.7 billion to $14.9 billion, and you grew your EPS from $3.55 to $7 in 2020. But in 2021, it dropped, and it's not exactly clear why it dropped. It looks like this is an anomaly. So this EPS is probably closer to 5% here. So most likely, you have a 5% earnings yield, you're growing 5%. You're really going to get your dividend yield, which is lower than that. So let's call it 3 or 4% plus 5%. You're talking about potential returns of this company of like 7 to 8%. Now, it's likely to be a low volatility 7 to 8%, which is actually better than bonds, but it's not going to be outstanding. And that actually could get worse over the next decade because, again, interest rates are going up. Now, if you're enjoying this video so far, hit that like button. Don't forget to subscribe. Your likes and subscriptions tell YouTube you're enjoying this content. So I would really appreciate you hitting that like button. So, income statement. Let's see what we can see here. So you can see that the operating expenses growing about 50%. Revenue's basically doubled. They've had a huge growth in revenue in the last 2 years. So I don't really know what that is, but that's really important to the future of the company if they can continue to grow that. Although it looks like their cost of goods sold is going up as well. It's probably just the regulatory environment allowing them to upsize, maybe high natural gas prices, something along those lines. Yeah, you can see this other non-operating income affecting that 2021 number we saw on the page before. If you take that out, then the company looks a lot better. So it's a little overstating it. Now, one of the things you see a lot with these utility companies that I don't like is you see this dilution. So they've gone from 172 million shares outstanding to 194 million shares outstanding. So they've increased it by 22 million shares, a little over 10%, 10 to 15% growth in shares outstanding. So that's going to reduce your EPS growth by about 1 to 2% a year over the course of a decade. So that's a problem. So instead of, let's say, an 8% return, maybe you're expecting a 7% return because you're getting that dilution added on. So, you have that revenue growth. If you had to do a quick math, maybe it's, 5% earnings yield plus 5% revenue growth minus 1% dilution. So that's, that 558. And again, we think that dividend yield's playing in here. So, you go there and so you get down to that 7% return. Balance sheet. So your PP&E's doubled. See, this is the problem with utility companies is they have to reinvest a lot of money back into their capital in order to stay afloat. So if you're not growing your revenue as fast as your capital, you start to have problems. I mean, they've doubled it from $13.7 billion to $27 billion. That's a lot, but they've not doubled their revenue. They're close, but their revenue is not growing as fast as their assets. Their earnings aren't growing as fast, and that's just a problem for them. And meanwhile, your debt has also doubled from $7 billion to $14 billion. And again, you're going to pay a lot of interest cost on this $14 billion. So your shareholder equity, interesting piece here, $7 billion, $8.7 billion. It's not really growing that much. You're basically paying everything out to shareholders, which isn't a big problem. That's actually probably good for shareholders. You don't want to retain a lot of money in this business. If you can float it by debt, that's going to be better for you, but you're just not getting the returns you need. I mean, you can see that really easily on the cash flow statement with this depreciation and amortization. Depreciation basically being higher than net income every year, and the PP&E being higher than depreciation. I mean, if you take the PP&E here and you do net income plus depreciation, it's the PP&E investment. What that's really telling you is you don't really have free cash flow in this business. All the cash from operations is going back into the business. Your net income isn't really probably a real number. You're just not earning your justification on this capital. Like you don't have the cash flow for these dividends without taking on more debt. Like you had $3 billion in cash from operations, $3.8 billion from investments. So you're negative 700 million, and yet they still chose to pay out a dividend. How did they do it? They raised 1.6 billion in debt. Again, here you have cash from operations, 3.6 billion. You spent 3.8 billion on PP&E, and yet you still paid a dividend. So like they don't have the cash flow. There's no free cash flow in this business. The only way they're staying afloat is continue to issue debt, which is going to get harder and harder as interest rates rise. For me, I would avoid this business. So the problem is just that free cash flow thing is killer. And the reason you have the negative free cash flow is partly the low returns on invested capital, and partly you're not growing fast enough. Because it's probably a regulated business, they're just not allowing them to price the cost of the utility high enough. And this is common for utility companies. They're regulated in a way that makes it really hard for them to keep up. They have certain expectations of what they have to spend on assets, and they can't get around that. And so they just get stuck in this issue where they just can't justify the cost they're spending. And so they will pay dividends to shareholders, but usually it's kind of like floating it through debt. And I think the future for shareholders is pretty bleak in this company. So I would avoid it. It's not going on my watch list. I hope you enjoyed this video. I hope you learned something. Please hit that like button. Don't forget to subscribe. Ring the bell so you can get notified as I upload new videos every week. Monday, Wednesday, Friday, we're covering new stocks in the S&P 500. I've already covered 140. The playlist above will have the whole list of those, or you can check out my past videos on this topic. And if you enjoy this type of analysis, I encourage you to check out quickfs.net. The first link in the description below is my affiliate link. If you sign up using that affiliate link, then I can get a commission for sending you to them. This is the software I use for myself. I don't recommend something I don't use myself, and I hope you'll check it out. It's a great way for you to support the channel and for you to use a new tool that I think will help you in your analysis. So quickfs.net. Doesn't cost you anything extra. Sign up for a free or paid account using my affiliate link in the show notes. Thank you for listening, and until next time, stop paying fees, start building wealth.